In 2026, could you realistically make a 15% annual return just by swapping currencies? That's what a carry trade aims to do, and right now, the global economic stage is setting up some of the best conditions we've seen in years for this strategy. Imagine borrowing Japanese yen at 0% and investing in Mexican pesos yielding 11%. Sounds like easy money, right? But as seasoned investors like Ray Dalio know, easy money often hides hidden risks. Remember 2022, when the Fed started hiking rates and the yen plummeted? Carry trades got absolutely crushed. So, with central banks around the world, including Jerome Powell's Federal Reserve, navigating sticky inflation and varied growth, what makes 2026 different? And what exactly are the subtle signs that tell us if these conditions are truly prime, or if we're walking into another trap? Alright, let's talk about something that's quietly been generating some serious buzz in financial circles. The carry trade. Now, if you're thinking this sounds like some obscure Wall Street secret, you're not entirely wrong, but the conditions we're seeing right now are making it more relevant than it has been in a long time. In fact, Goldman Sachs recently highlighted that the expected returns on carry trades are at their highest in 2 decades. We're talking about a potential annualized return in the neighborhood of 6.6% on some major currency pairs. To put that in perspective, the average return on carry trades over the past 30 years has hovered closer to 3.5%. What's making this strategy so attractive right now? Well, the global interest rate landscape has shifted dramatically since early 2022. We've seen central banks, especially the Federal Reserve under Jerome Powell, aggressively hike rates to combat inflation. This has created massive divergences in interest rates across different countries, bigger gaps than we've seen in years. We're going to dig into why these gaps are the carry trade's best friend. The Bank for International Settlements even noted in September 2024 that market turbulence in July and August actually amplified these opportunities, rather than diminishing them. Now, you might remember currency carry trades from before the 2008 global financial crisis, when the Japanese yen was a popular funding currency. The dynamics are different now, but the underlying principle is the same. We're going to break down how these trades work, using real-world examples, so someone in your situation can understand the mechanics behind this significant shift in market conditions. The lesson here is understanding how macroeconomic policy directly impacts investment opportunities, even those that seem complex at first glance. So, what exactly is a carry trade? Think of it this way. You're essentially borrowing money in a currency where interest rates are super low, and then you turn around and lend that same money in a currency where interest rates are much higher. The magic, the core profit mechanism, comes from that difference in interest rates, also known as the interest rate differential. A classic example is borrowing Japanese yen, historically a very low-interest funding currency, sometimes near 0%, and then investing those funds into something like the Australian dollar, which has often offered higher yields. Say, for instance, in 2022, you could have borrowed yen at 0.1% and invested in Australian bonds yielding 3.5%. That 3.4% difference is your potential profit. Now, this strategy sounds great on paper, but it heavily relies on one crucial factor: stable or at least predictable exchange rates. If the Japanese yen suddenly strengthens significantly against the Australian dollar, that currency movement can quickly eat into, or even totally reverse, any interest rate gains. Imagine you borrowed $1 million yen, converted it to Australian dollars, earned your interest, and then when you went to convert back, the yen had gotten so much stronger that your Australian dollars bought fewer yen than you initially borrowed. That's the big risk. As the BIS Quarterly Review noted in a September 2024 analysis, market turbulence and de-risking pressures in early August, following perceived hawkish Federal Reserve signals, can quickly impact these positions. The lesson here is that while the interest rate differential is the engine, currency stability is the road. This brings us to some fascinating research. A classic, often cited example of the carry trade involves borrowing Japanese yen, historically at ultra-low rates, perhaps 0.1%, and investing in higher-yielding currencies like the Australian dollar, which might offer 4.3%. That 4.2% spread represents the raw potential profit. However, the true mechanics extend far beyond mere interest rate differentials. Leading academic research provides a much more robust framework for understanding not only why these trades generate returns, but crucially, why they occasionally unravel. One of the foremost voices in this field is Wharton finance professor Nikolai Rusanov. Collaborating with Robert Reddy from the University of Rochester and Colin Ward from the University of Minnesota, Rusanov co-authored the seminal paper, Commodity Trade and the Carry Trade. A Tale of Two Countries, published in the Journal of Finance. Their work delves into the intricate connection between global commodity markets and currency carry trades. They demonstrated that economies heavily reliant on commodity exports, such as Australia with its iron ore and coal or Canada with crude oil, often see their currencies become attractive carry trade targets. This is because strong global demand for their primary exports bolsters their economic outlook and, consequently, influences their central bank policies, leading to higher interest rates. For instance, the Reserve Bank of Australia's policy rate, often influenced by commodity cycles, provided a stark contrast to the Bank of Japan's near-zero stance. This necessitates sophisticated analysis, extending well beyond a simple comparison of overnight interbank rates. It demands a deep understanding of the entire economic landscape driving these differentials and their interaction with global trade flows and capital mobility. The lesson, therefore, is that while the carry trade appears deceptively simple at first glance, its underlying dynamics are profoundly complex and deeply interconnected with broader macroeconomic forces, including supply chain shifts and geopolitical events impacting commodity prices. This academic perspective helps us appreciate both the long-term viability and the subtle, often hidden, risks involved, particularly during periods of increased market volatility like the taper tantrum of 2013 or the COVID-19-induced shocks of 2020. The simple truth is, even the most promising strategies face headwinds, and the carry trade is no exception. We saw this play out earlier this year. According to the BIS Quarterly Review published on September 16, 2024, market turbulence significantly impacted carry trades. We saw de-risking pressures first emerging in early July, and then really intensifying as we moved into early August. Think back to July. We were seeing corrections in tech stocks, and overall market volatility was on the rise. This isn't just a side note. Higher volatility makes carry trades riskier because the exchange rate movements can quickly erode any interest rate differential profit. The true cusp of the stress hit in early August, and what triggered it? Perceived hawkish signals from the Federal Reserve. For instance, if Jerome Powell or another Fed official even hints at unexpected rate hikes, that can send ripples across global currency markets. Suddenly, a currency you borrowed cheaply might strengthen against your investment currency, or vice versa, squeezing your profit margins or even turning them negative. Consider someone who, in June, borrowed yen at 0.1% and invested in Mexican pesos yielding 11%. If the Fed's hawkish tone caused a sudden 5% appreciation of the yen against the peso in early August, that person's 10.9% interest differential just got significantly eaten into by currency movement. The lesson here is that central bank policy shifts and market volatility are critical determinants for carry trade performance. It's not just about the static interest rate difference, it's about navigating these dynamic shifts. So, who exactly is playing this game, and how do they manage these risks? Let's dive into who's actually putting these strategies into action. Now, who actually gets to play this game? You might think it's just the big institutional banks, but individual investors can access carry trades through various brokers, though it's not always straightforward. For instance, platforms like Just2Trade facilitate international currency trading, allowing retail investors to participate. However, the regulatory landscape is constantly shifting, impacting access. Take Lime Trading, CY, Ltd, for example. We saw them cease providing services to the UK market and UK resident investors by late 2023. This kind of move highlights a critical point. Regulatory changes and specific broker policies directly impact where and how investors can execute carry trades. When you're dealing with cross-border strategies like carry trades, choosing a regulated broker is paramount. It's not just about protecting your capital, but also ensuring that the trading environment is transparent and adheres to international standards. For someone considering these types of trades, understanding the regulatory body overseeing their chosen broker, be it the FCA in the UK or CISCC in Cyprus for Lime Trading, CY, Ltd before their exit, is a non-negotiable step. The implications of a broker ceasing services in a region, like Lime's decision regarding the UK, means less competition, and potentially fewer options for investors in that specific market. It narrows the window of opportunity and forces investors to seek out new, compliant platforms, adding an extra layer of due diligence. The lesson here is that while the carry trade itself is about interest rate differentials, access to it is heavily dependent on the ever-evolving world of financial regulation and broker availability. This brings us to why these conditions are more relevant than they have been in a long time. Now, why might now be considered a particularly interesting time for carry trades, despite that recent market turbulence we just discussed? Well, it boils down to a few key conditions. A lot of the chatter, even after the de-risking in July and August, centers on diverging monetary policies globally. Think about it. The Federal Reserve, under Jerome Powell, has been hiking rates aggressively, pushing the US dollar's yield higher. Meanwhile, other major central banks, like the Bank of Japan, are still keeping their rates ultra-low, perhaps even negative. This creates significantly wider interest rate differentials than we've seen in years. Consider a scenario where the US Fed is holding its Fed funds rate around 5.5%, while the European Central Bank, for instance, might be considering cuts from a lower base later in the year. That difference, say 200 or 300 basis points, represents a much juicier spread for a carry trade than when all central banks were largely moving in lockstep during periods of coordinated easing. Wharton finance professor Nikolai Rausanov, who co-authored Commodity Trade and the Carry Trade, often highlights how these macro policy shifts are fundamental drivers. Beyond just the rates, a period of anticipated currency stability also makes carry trades much more attractive. After periods of high volatility, like we saw with the intense de-risking pressures earlier this year mentioned in the BIS quarterly review dated September 16, 2024, markets often settle. If major currencies aren't expected to make sudden, sharp moves against each other, the exchange rate risk, which is the Achilles heel of the carry trade, diminishes significantly. This current environment, with many central banks telegraphing their intentions fairly clearly, could be seen as one where that stability is a bit more predictable, at least in the short to medium term. The lesson here is that wide rate differentials combined with perceived currency stability create the optimal hunting ground for carry. But, of course, unexpected policy shifts, like a sudden hawkish pivot from a central bank expected to cut, or a resurgence of market volatility, always remain the inherent risks that keep even the best conditions from being a sure thing. Indeed so, while the current environment with its clear monetary policy divergence, like the Fed's aggressive hiking under Jerome Powell contrasting with more dovish stances elsewhere, certainly sets up what appear to be prime conditions for carry trades, it's critical to see the full picture. This isn't a set-it-and-forget-it strategy, it's a dynamic, high-stakes game where geopolitical shifts, sudden policy pivots, and even seemingly minor market tremors, like the de-risking we saw in early July and August of this year, can unravel positions rapidly. The lesson here is that understanding the true mechanics, the systemic risks highlighted by institutions like the BIS, and the intricate dance between interest rate differentials and market sentiment is paramount for anyone looking to navigate these waters. Have you ever dipped your toes into international currency trading or felt the ripple effects of diverging central bank policies in your own portfolio? Share your experiences, or even your questions, down in the comments below. And if you want to keep peeling back the layers of complex financial strategies and get the data-driven insights you need to make sense of the market, make sure to hit that subscribe button. Next up, you should definitely check out my deep dive into how options trading can amplify both gains and losses in volatile markets. It's a perfect companion piece to understanding risk and high leverage strategies.